book. So we were talking about finance. For finance, we said it's the money that's needed by the business uh, to operate. Hmm. So the money, it would be needed at all the stages. When the business starts, they'll need the money then. When the business they are operating, obviously at start they'd be needing for different things, and when they continue their operations, there are certain activities which would happen only at the start of the business. Okay, so for example, getting your business registered with the relevant authorities, getting for example, paying an upfront amount, a lump sum, perhaps if the owner of the building where you carry out your operations, they ask for one. So that's going to be a security deposit or something, most probably a one-time payment. Legal registration, some specific marketing, some specific brand registrations, these sort of things that happen only once. And the other business activity, for example, the good chunk of it would be buying and selling stuff. So you would be buying the raw material, you would be hiring different people and paying them their wages. uh, Machinery, equipment, buying cost, if your business is also capital intensive or it requires a lot of capital or machinery to work. uh, okay, the term that I was forgetting earlier on, it was capital employed. Now I remember. Anyhow, so all these things, many of these, they would be there at the start. And the operations, the usual buying and selling stuff, employing people, paying them their wages, then buying material, converting that material into finished good, carrying out the advertisement, these are the things that you would carry on even in the normal course of business. So that's one way of classifying business, of classifying finance, as in what's the point of time when you'd be needing it. If you classify according to that, you'll have startup capital and you'll have working capital. Okay, so one is called, and we'll soon see the formula of how we calculate the working capital, but in a bit. So I've got one thing I call startup capital, and the other way of uh, the other category would be working capital. If I look at finance as in who is the person who is financing the business, or who is the person who is providing finance for the business, person or group of persons, that would be classified into equity and liability, right? So we have got something we call accounting equation. All the assets in the business, they are equal to equity plus liabilities. All the assets that are there in your business, either they come from the money of the owner or they come from borrowed money. Make sense? Okay. Another way of classifying finance is how long it is available with the business. If we classify it according to that, then we have got long-term finance and short-term finance. Short-term finance is something that is available for less than 1 year. Long-term finance is something that will be available for the business for with the business for more than 1 year. So let me write available for more than 1 year. Okay. Everything that I've said this far, it makes sense and you understand it? Acha ji. Uh, let's talk a bit about what are the different things that the business. Okay, so we said that a business, it would need startup capital and it would need working capital. Hmm. Acha, I just remembered that this is the first time that I'm discussing the portion of finance with you, right? Acha. For finance, a few things that we also perhaps should discuss right now. Maybe these things they'll come later on in your book, but if we discuss them now, we'll be spending less time on those later on. So, where is the financial information for any business available? Businesses usually they are supposed to make and present their financial information each year in the form of a few statements, what we call financial statements. Financial statements. What are those financial statements? There are five statements which are prepared, a set of five statements which is combined called financial statements. Out of those five, we are majorly concerned with just three. The first one is what we call statement of financial position. Statement of financial position, or sometimes we write the short term for it SOFP. Okay. The second major statement is what we call income statement. Acha, income statement has got a few other names as well. So, for example, income statement has sometimes we also call it statement for profit or loss. Okay, but usually we'd be using the term income statement. And the third most commonly used, or for our purpose, the most important statement, it is cash flow. Okay, cash flow, sometimes we write the short form CF. And to give you a quick summary of what are the contents of these financial statements, the statement of financial position, it is prepared on the principle of accounting equation, what I just wrote, that all the assets that are there in the business, they are funded either from equity or from liability, right? Acha. Now the question would be that what is asset, what is equity, what is liability? Asset are all the resources that are available for use with the business. Resources which are available with the business which can be used later on. Acha, having understood that, the equity is basically the residual interest of owner in the business. I've got assets, all these resources that I can use. These resources, they can take form of, for example, premises. They can take form of vehicles. They can even take form of intangible assets such as receivable. I sold something to someone, and that person said that he'll pay me at a later date. So this receivable, this right to receive money from that person at a later date, it will be an asset for me. Acha. Then I've got liabilities. Liabilities are the amounts that a business it owes to outside business, people outside the business. Why would I owe money to people outside my business? Maybe that I borrowed straight away money from them. I took a loan. Then I'll be liable to pay them. The other scenario could be when I buy something from someone on credit. You understand? You remember the cash and credit transactions, right? Did we discuss those before? Achha, there are two types of transactions in business. One we call cash transaction, the other is called credit transaction. Whenever you buy something, you have the option of paying immediately and upfront. That is what we mostly do. And the other case is that you tell them that I'll pay you at a later date. Even if you're paying through your debit card, that is also immediate payment because the amount it gets immediately deducted from your bank account, right? Acha, back. As a startup capital is the amount of money that would be needed to start a business. Amount of money you finance needed to start the business. Just a second. Working capital is the amount of money needed to carry out day-to-day operations. Day-to-day transactions or day-to-day business. So, for example, business registration cost, it would be included in the startup capital. Paying your utility bills, it would be something that would be there in for this you'll require working capital. Acha ji, having understood this, financial statements, I told you that statement of financial position, it is prepared on the equation of assets are equal to equity plus liabilities. There would be a whole chapter in which we'll study these financial statements in depth. I'm just giving you an overview so that the terms that we use from this section, you know what that means. Acha, the second statement I mentioned is income statement. Income statement is prepared on the simple principle that your revenue minus your expenses, it equals either profit or loss. If your revenue exceeds your expenses, then you have got profit. If your expenses they exceed your revenue, then you have got loss. Simple. You have got revenue minus expenses. The revenue minus expenses, there can be only two scenarios. So for example, the first scenario is that your revenue was 100 million and your expenses were 80 million. In this case, you'll have a 20 million profit. This is revenue, this is expenses, so 20 million profit. But if I reverse the situation, that your revenue is 80 million and your expenses are 100 million, now you will have 20 million loss. Understood? Acha, one more thing for finance, when we are preparing the information, especially the statements, if ever you see a figure written in bracket, it would mean that this is a negative amount. So over here, this would be in bracket. Or for example, the expenses being deducted, I'll put these in bracket. Okay, make sense? Acha, we have discussed the working capital, we have discussed the startup capital, we have discussed the what's liability and what's equity. Liabilities, for liability, I was giving you situations that you could have a liability when you borrow money from someone, it would give rise to liability. Another case for liability is when you are when you have purchased an asset on credit. And for credit, I was telling you that there are two types of transactions: the ones you immediately pay for, and the ones that you pay for later on. Credit and cash. So examples of credit transactions are the utilities that we use. For example, electricity bill, we use it for the whole month, and then at the end of the month, we get bill for the amount that we have already used. Okay, so it would give rise to payables. And cash, if you're buying something using a credit card, not debit card, a credit card. So the credit card company is the one which is providing us with credit. They are sort of extending us loan, and then they send us the bill at the end of the month, which has to be settled till a particular due date, right? So that is also an example of credit transactions. Acha, so in statement of financial position understood, income statement understood. The third statement is cash flow. Cash flow statement, the broad principle it is that cash inflow minus cash outflow. No, it will be equal to net cash flow, and net cash flow plus opening cash, this will be equal to closing cash. Okay, so it means there is an error somewhere. You didn't record something, or you recorded a wrong amount. There's an error somewhere, or you have missed something. So think of it this way, that at start of a month, let's say for the month of August, right now you have got cash of how much? Let's say 5,000 dirhams. Okay, and then you sell your Minecraft merchandise and you make, let's say, 800 dirhams. Okay, and in creating that Minecraft merchandise, for example, you had to buy a few things, let's say 100 dirhams at max. So that would mean that the net cash flow, the amount that inflow and outflow, if I net that, 700 was generated from this activity plus 500 that you had at start of the month. So your closing cash, it should equal 1200 dirhams. At start, I wrote 800 dirhams, the amount that you made by selling your merchandise. and then you deducted from it 100 dirhams, the cost that you incurred in, I mean, the cash outflow that occurred when you were selling this thing. 100, I said. Acha, write it down, then I'll tell you something else as well. Maybe I mentioned it before, but now is a good time to mention it again. The other thing that I want to mention is that cash flow is not equal to profit. Profit and cash flow could be different. Think of it this way, that you have a business in which you sell. What do you sell? Let's just say you have a stationery business and you sell stationery. So for your business, you sold stationery worth, uh, let's say 1,000 dirhams to keep things simple. Okay. So the stationery you sold is worth 1,000 dirhams. And in order to sell that stationery, uh, I mean, when you sold that stationery, you had to buy it before you sold it. So when you bought it for, your cost was, let's say, AD 40. It means you have earned a profit of 40, sorry, 60. This is your profit. Now cash flow could be different. It could be that the inventory that you sold it on credit, but whatever you purchased, you paid for it. So your cash outflow is 40, cash inflow is nil, and your net cash flow is negative 40. So I'm saying that you sold this inventory on credit. So if you sell something on credit, would there be some cash inflow for it right now? When they pay it at a later stage, then there will be the cash inflow. Right now, the cash inflow will be zero, right? So 0 minus 40, it would mean that right now you're running a cash deficit of 40. Similarly, so the point is that to, to show that it's a negative amount that I'm going to subtract it. The same way for, no, it means 0 minus 40. Okay, so just to show you that profit was positive 60 and the cash flow as of now it is negative 40. It could take another form as well. The second form could have been that I sold the inventory on cash, so I got cash inflow of 60, but cash outflow was nil. I haven't paid the person from whom I initially bought this inventory. I told him that I'll pay you when I eventually sell it. So uh, that's what I'm trying to say you, that yes, the amount that would appear over here, oh, I'm sorry, I'm selling it for 100, so the amount that will appear over here is 100. I'm selling it for 100 now, so the amount that I'll get is 100. The all the that I'm trying to say over here is that the amount of profit, this circled amount, this is profit, and these are cash flows. Cash flow can be different from profit, and it's not mandatory that it will always be different from profit. At times it can be the same. So for example, if I carried out this whole transaction actually in cash, that I sold goods on cash, I bought goods on cash, then the cash flow and profit will be the same. But we must bear in mind that cash flow is something different and profit is something different, and I can have different amounts for both from the same transaction. Okay, acha ji, so this understood. Then the next thing, acha, coming back to what we were saying over here, that the business, it would, a way of classifying finances, classifying it in the form of short term and long term finance. Um, if we look at the short term and long term finance, for short term finance, we said that it is going to be from the From the it has to be it is going to be available for less than 1 year. So can it be from equity? The sources of finance are two: equity and liabilities. Can short term source of finance be from equity? Mm, exactly. So most probably it's going to be from liability. Also from liabilities we have got two kinds. What are the two kinds? We call them non-current liability and current liability. Okay, non-current and current, it's the term that we'll keep on using. We'll use it for assets as well as like we're using it for liabilities like right now. Current means anything that will convert into cash within 1 year. Current is NCL. Okay, we begin with saying that there are two forms of finance in the on the basis of classification, that for how long it's going to be available, this money. If it's going to be available for less than 1 year, then it's short term finance. And if it's going to be available for more than 1 year, then it's going to be long term finance. So, so you want the definition for equity and liabilities? Why did I write it over here? I wrote it over here to tell you that equity cannot be in the short term source of finance. The short term the short term finance, it's going to be from the liabilities. Plus, not all the liabilities they will be the short term finance. Within liabilities, I have got uh, non-current liabilities and current liabilities. These non-current liabilities, they will also not be short-term finance. Only current liability is short-term finance. Now your question would be that what is current liability and what is non-current liability? For that, I'm giving you a general rule. Whenever we use the term current, it means that with whichever term I'm using it with, this is going to convert. Current is anything that will convert into cash within 1 year. Within 1 year. If it's a current asset, it will convert into cash within 1 year. And if it's a current liability, it will also convert into cash, as in it will get paid within 1 year. When does the liability convert into cash? When I pay it. Okay. So current liability means all the amounts that I'm liable to pay within 1 year, those are my current liabilities. All the amounts that I'm liable to pay within 1 year, that I'm obliged to pay within 1 year, those are my current liabilities. Okay. And now for the long term source of finance, it would mean that equity would come over here and non current liabilities will come over here, because equities, that's the permanent investment of owner in the business. And non current liabilities, yes, I have to pay back these amounts, but not at least within 1 year. Okay, so this will be my long term source of finance, the equity. I sometimes also call this equity plus non current liabilities, I give it another name, I call it capital employed. Capital employed. Understood? Acha ji, this. So these are the different ways I can classify the finance of the business, depending on who is funding, for how long the money is going to be available, and when exactly is that money going to be used. Now what we are going to look at is that we are going to look at a bit deeper on this portion when we said the who's going to fund it. So for the business, we'll say that finance, it can be classified into two categories: the internal finance and external finance. So now finance, we are saying that there is a category called internal finance and there is a category called external finance. There is internal. Acha, sorry, just note it down. There was one thing that I forgot from before. Acha, over here, when I said the short-term source of finance, obviously, since the money is available with me for a period of less than 1 year, I cannot spend this money in long-term projects. If I spend this money, if I tie up this money in projects which are going to pay me back or which are going to get converted into cash in the long run, how am I going to pay back for this? These current liabilities I have to pay back within 1 year. So usually most probably the short-term source of finance, it will be used to fund the working capital, and the long-term source of finance, it will be used to for the long-term projects and for the expansion of the business. Whenever, sure, go ahead. Acha ji, just a small thing to add. I said that the business, it would need finance for startup capital, working capital, as in when would the business be needing money. I could add one more category over here. The third category that I can add over here, as in when the business, it would be needing money, is when the business, it decides to expand. So for expansion as well, the business would need money. We don't call it expansion capital. We just say that when the business decides to expand, it would need finance for that. Okay. Now coming back to the sources of finance, we said that broadly speaking, we have got two sources of finance: the internal sources of finance and the external. The difference between the two is that, first of all, the internal sources of finance, they are the ones that are generated by the business from own resources, from what they already own. Generated from internal resources. Acha ji, the next thing is that since they're generated from the internal resources, they do not have to be paid back. I mean, you're using your own resources, so who do you have to pay back? There is no payback for these. All right. Acha. The third feature for these, when we look, okay, let's look at what these different venues are from which we can internally generate the finance for the business. The first one would be the personal savings of the owner. So I write personal savings. The owner, they have already invested some amount. This is for the unincorporated businesses like the partnership and sole proprietorship. They want to expand their business, or the business, it needs money for whatever reason. Now we are not saying that for what purpose. We are saying that the business, it needs money. So one source of finance, it could be internal, and from the internal sources of finance, the first example is the personal savings of the owner themselves. that they invest more money in the business. The second source could be retained profits. So whenever a business earns a profit, it can do two things for it, out of it. The first possible option is that they distribute it among the owners, that we earned this profit using your money, so here is your share of it. The other thing that the business it can do is it retain and hmm, could you come again, ask this thing again? I didn't get what you're saying. Hmm. Hmm. Nahi, the personal savings would be that the personal say anything. Acha, for business we use this principle called do what's that? Separate entity principle. Business is separate entity from the owner. If you start a business, you'll have a personal account and you'll have a business account. What lies in the business account is for the business. What lies in your personal account is for yourself. Okay. Another thing we have, since we have already studied the different structures of businesses according to the ownership, we know that there are businesses with unlimited liability and there are business with limited liability. If you remember, for sole proprietorship and for partnership, we said that the businesses they have unlimited liability, and for the companies, private limited company and public limited company, we said that they have limited liability. For limited liability companies, it is for sure that the business it's going to have its separate bank accounts and everything is going to be separate. For the unincorporated businesses, usually the lines they get blurred, but still whatever has been allocated for the business, it will be counted as the asset of business. And the assets of the business, it would include the bank account. You'll have to, the owner, it will have to make allocation that this is business's money and this is my personal money. Okay, so whatever their personal savings are, the business has got nothing to do with that, unless the business it needs finance and the person they choose to finance that particular need by bringing in more money from outside the business from their personal savings to the business. That is different from if the business it were earning profit and the owner he wasn't taking his share from the business, or the owners they weren't taking their share from the business, they were rather reinvesting that amount in the business. So whatever they're reinvesting in the business, it is staying in the business, so it can be used as a source of finance for later days when the business it needs finance. Do you get it, that how the two are different, or are you still confused? Okay. So one we said personal finance. The second we said retained profit. The third source of finance for internal finance could be selling assets of the business. So you had some assets, for example, a vehicle or a building or some other asset that you're currently not using. And in order to finance your business, you choose to sell it. Acha, the downside of using this way, selling your asset to finance your needs is that yes, it will give you money, but the problem is that usually you buy assets so that they can provide you benefit in the long run. Now, hmm, so think of it this way, that you bought a computer for doing some programming and to earn a living. Okay, and then for your business it needs cash. If you sell your computer, yes, it would give you cash right now, but what about all the earnings that it was generating for you? You won't be able to earn those right now. Immediate cash needs, yes, those will be met, but at the expense of long term cash flows that this asset could have generated. Okay, so these are a few benefits that I wrote on the screen, that for internal source of finance, first of all, it's generated from internal resources. It doesn't have to be paid back. The downside of internal sources of finances, that first of all, it will generate a small amount. First of all, you wouldn't have, I mean, in normal circumstances, you wouldn't have a lot of retained profits just lying vacantly around, not being invested anywhere. So whenever you need finance, you can take away from that. Usually, that's not businesses. They do not keep their assets idle. Similarly, for the personal savings, the owner of the business, I mean, how much can they reinvest? They've already invested a good chunk when they started the business. It's unlikely that they'd keep on spending whatever, I mean, they'll keep on reinvesting whatever they initially invested, the same amount or more. So usually these internal sources of finance, they are in smaller, they generate a smaller amount. The other problem is what we said with the selling of assets, that it cannot be used for I mean, this short term cash flow, it's generated at the expense of long term cash flows or profits that the asset could have generated. So this is a downside. The other downside is that generates short term inflows at the cost of larger long term profits. Do you get it? This point? Sure. Acha ji. Let's now move to external sources of finance. For the external sources of finance, let's discuss a few examples. And first, the definition. So, external finance is finance obtained from outside the business. Finance obtained. Acha ji. And obviously, now comparing it with the benefits and drawbacks of internal sources of finance, the first drawback of external sources of finance would be that either it will have to be paid back if you are borrowing from someone, or if you are bringing on another person as owner of the business, you would be giving away a portion of your equity. Your shareholding would dilute. So, more money from outside the business, how can you get it? Either you take a loan from someone, so in that case, you'll have to pay them back, or you ask someone else to join as an owner and they bring their own investment. In that case, your shareholding or equity will be diluted. Shareholding will be diluted. Acha, the short-term source of finance, they usually generate smaller amounts for you. So here's the good news, that in this case at least, you will be able to generate larger sums of money. Acha, another upside of the internal finances, that it is quick to arrange. External won't be. It would take uh, more time to generate cash inflow. Could take more time for inflow to happen. So, for example, if you are borrowing from bank, it would take you a good, I mean, some amount of time to negotiate the terms and get all the documentation ready. For inflow to happen. And if you're going for the equity financing, obviously you'll have to meet with a lot of requirements of the regulator before you bring someone on as your partner. even if it were in unincorporated business, for example, a sole proprietor, they decide to turn into a partnership, or a partnership, they decide to bring on a new partner. They'll have to first find a suitable partner and then have to go through the documentation that they have to go through. Acha, generate long term. So that's something specific to this. Acha. Now let's look at a few examples of what these external finances are. The external finances are, again, these external finances, I will break them down further into short term and long term. For external sources of finance, I can break them down into short term and long term. Okay, so the short term external sources of finance, they include bank overdraft. Have I explained it to you before what bank overdraft means? So bank overdraft is, let's say you have a bank account of 1000 dirhams. This is your bank account, and now you need to make a payment of 1200 dirhams. In the ordinary, in the normal course of circumstances, you usually have a lot of money in your bank account, plus a lot of money flowing in and flowing out. But as of now, it so happens that you have got just 1000 dirhams in your bank account, and right now there is an immediate pressing need of making this payment of 1200 dirhams. Okay, the question is that would your bank allow you to make this payment beyond your bank account, beyond your bank balance? For businesses, it usually does. For individuals, most probably it will deny. But for businesses, it will see that this person, yes, it he or she has the sum of money in their bank account, and they are a genuine person. They have got a genuine business running on, and this happens to be a genuine need. So yes, it could happen that right now they're short of cash. So what they'll do is they'll allow this amount to be deducted from your bank account, 200 extra over and above your bank balance, and in your statement your bank balance would appear as 200 negative. Okay, and bank account, which is normally your asset, it would get converted your into a liability. You owe the bank, and now the next time you deposit some money in the bank, whenever, so for example you deposit 500 dirhams in your bank account, it will appear as 300. It's fine. It's fine. No, no problem. I understood. Achha. So I was saying that the next time you now deposit this 500 dirhams in your bank account, your bank balance would now appear as AED 300, because first you'll deduct the overdrawn amount. This is called overdrawn amount, and this situation is called bank overdraft. So bank overdraft, as we can see, that it can be a short term. Usually, they'll allow you an overdraft for a month or a short period of time. Beyond that, they'll charge you a hefty rate of interest. Okay, a very high. But for